Central Bank Digital Currencies, commonly referred to as CBDCs, have become one of the most significant topics in global finance, sparking debates among economists, policymakers, and technologists about the future of money itself. A CBDC is essentially a digital version of a country's national currency, issued and backed directly by the central bank, the same institution responsible for printing cash and managing monetary policy. Unlike cryptocurrencies such as Bitcoin, which are decentralized and operate independently of governments, CBDCs are centralized, regulated, and fully tied to the authority of the issuing state. The core idea is simple. Instead of holding paper money or coins, individuals and businesses would hold a digital form of legal tender, accessible through secure digital wallets. While the idea may sound straightforward, the implications of CBDCs reach deep into economics, technology, privacy, and even geopolitics, making them one of the most transformative potential developments in the financial system. The motivation for CBDCs arises from several key factors. First, the global economy is rapidly digitizing. Physical cash usage has been declining in many countries as more people prefer electronic payments, mobile banking, and contactless transactions. Central banks are concerned that if they fail to innovate, private companies and decentralized cryptocurrencies could dominate digital payment ecosystems, potentially weakening the central bank's control over monetary policy. CBDCs provide a way for governments to modernize their currencies, ensuring they remain relevant and functional in a digital-first economy. Second, the rise of stablecoins, cryptocurrencies pegged to the value of fiat currencies, has added pressure. Companies like Tether and Circle issue digital tokens backed by the US dollar, which already circulate globally in the billions. Central banks view these private digital currencies as potential threats to financial stability, since they operate outside the direct control of regulators. By introducing CBDCs, governments can provide a safer, more reliable alternative with the same convenience but greater oversight. CBDCs can be broadly divided into two categories: retail and wholesale. Retail CBDCs are designed for everyday use by the public, functioning much like cash but in digital form. For example, an individual could pay for groceries, transfer money to a friend, or settle bills using CBDCs through a government-backed wallet or application. Wholesale CBDCs, on the other hand, are primarily for financial institutions and large-scale transactions between banks. They aim to improve efficiency in interbank settlements, cross-border transfers, and large payments systems, areas where existing infrastructure can be slow, expensive, or outdated. Many central banks are exploring both forms simultaneously, recognizing that each serves a distinct purpose in the financial system. One of the most discussed examples of CBDC development is China's digital yuan, also known as the eCNY. China has been a pioneer in testing and rolling out CBDCs at scale, conducting pilot programs in major cities and integrating the digital currency into apps like WeChat and Alipay. The digital yuan allows the government to track transactions more closely, potentially giving it unprecedented visibility into economic activity. Meanwhile, countries like the Bahamas have already launched their own CBDC, the Sand Dollar, making it the first fully deployed central bank digital currency. The European Central Bank is exploring a digital euro, while the U.S. Federal Reserve is still in the research and consultation phase, debating whether a digital dollar is necessary or beneficial. Over 100 countries worldwide are studying or experimenting with CBDCs, highlighting the growing momentum behind the concept. The potential benefits of CBDCs are wide-ranging. One major advantage is financial inclusion. In many countries, millions of people remain unbanked, meaning they lack access to traditional financial services like savings accounts or credit. CBDCs could provide these individuals with access to a government-backed digital wallet, allowing them to participate in the formal economy without requiring a bank account. This has the potential to reduce inequality and empower marginalized populations. Another benefit is efficiency. CBDCs could make payments faster, cheaper, and more secure by reducing reliance on intermediaries like commercial banks or payment processors. For cross-border transactions, which are often slow and expensive due to multiple intermediaries and regulatory checks, CBDCs could streamline the process, enabling near-instant transfers between countries. Monetary policy is another area where CBDCs could play a transformative role. Central banks could implement policies more directly by distributing digital money to citizens during crises, effectively creating a modern form of helicopter money. They could also program CBDCs with conditions, such as expiration dates or restrictions on certain types of spending, to influence economic behavior. For example, in times of recession, a central bank might issue CBDCs that must be spent within 6 months to stimulate demand. While such programmability offers powerful tools for policymakers, it also raises significant concerns about government control and individual freedoms. Indeed, privacy and surveillance are some of the most controversial aspects of CBDCs. Unlike cash, which allows for anonymous transactions, digital currencies can be tracked and monitored. Critics argue that CBDCs could give governments unprecedented power to monitor financial activity, raising fears of mass surveillance, loss of privacy, and potential misuse of data. Authoritarian regimes could exploit CBDCs to control their populations more tightly, monitoring spending patterns or even restricting access to funds based on political behavior. Even in democratic societies, questions remain about how much financial privacy citizens would be willing to sacrifice for the convenience of digital money. Balancing transparency, security, and privacy will be one of the most difficult challenges in designing CBDCs. Another challenge is the impact on commercial banks. Currently, banks play a central role in financial systems, holding deposits and lending money. If citizens were to move large portions of their savings into CBDC wallets, banks could lose a major source of funding, potentially destabilizing the financial system. This phenomenon, known as disintermediation, could reduce banks' ability to lend, forcing central banks to rethink their relationship with the private sector. Some proposals suggest limiting CBDC holdings per individual or offering non-interest-bearing CBDCs to minimize competition with traditional deposits. Striking the right balance between innovation and stability will be critical for widespread adoption. From a geopolitical perspective, CBDCs also represent a tool of power and influence. China's digital yuan, for instance, could strengthen its role in international trade by offering an alternative to the US dollar in cross-border settlements. If widely adopted, it could reduce global reliance on dollar-dominated payment systems like SWIFT. Similarly, smaller countries may see CBDCs as a way to protect their monetary sovereignty from being overshadowed by foreign stablecoins or cryptocurrencies. As different nations race to develop CBDCs, questions arise about interoperability, standards, and the future of global finance. Will the world converge on a network of interconnected CBDCs, or will competing systems create fragmentation and tension? Technologically, CBDCs can be designed using either centralized databases or distributed ledger technology, DLT, the foundation of blockchain. Some argue that central banks should embrace blockchain to ensure transparency, resilience, and security, while others believe centralized systems are more practical given the scale and speed required for national currencies. Hybrid models are also being considered, combining elements of both. Regardless of the design, cybersecurity will be paramount. A successful attack on a CBDC system could undermine trust in an entire economy, making resilience against hacking and fraud a top priority. In conclusion, central bank digital currencies represent both an opportunity and a challenge. They offer the potential to modernize payment systems, increase financial inclusion, and enhance the effectiveness of monetary policy. Yet they also raise serious questions about privacy, government power, financial stability, and technological resilience. As more countries experiment with CBDCs, The world is witnessing the beginning of a new era in money, one that could redefine the relationship between citizens, governments, and the global financial system. Whether CBDCs become a tool of empowerment or control will depend on how they are designed, implemented, and regulated. What is certain is that CBDCs are no longer a distant concept but an active area of development that will shape the future of money for decades to come.